Shirley Carroll, the Director of Education, and I would like to welcome you on behalf of the North San Diego County Realtors to today's webinar, VA Loans 101 with Daniel Lehman. Before getting started, please note, next Wednesday, November the 2nd, YPN is hosting a blood drive at the Carlsbad Hub at 1903 Wright Place in Carlsbad from 10:30 to 3:30 p.m. For more details and to register, please visit nsdcrealtors.com. Okay, and a little bit about our speaker. Daniel Lehman is a Marine Corps veteran who got out of the service with $50 in his pocket, a wife and a new baby, and no idea what he was going to do. Through home ownership, financial literacy, and entrepreneurship, Daniel was able to build a great life for he and his family, and now aims to pay that back to anyone who will take the time to listen. Daniel's core focus is a mortgage lender are to help consumers better understand their financial options related to home ownership, help real estate agents better serve their clients and grow their business. So without any further ado, Daniel, I'm turning it over to you.
Hey, Shirley, can I verify real quick that that they're able to chat, right? Do they have, I know it's a webinar, so they have the function to kind of chat, to send questions and that kind of thing?
Absolutely. Any questions you have, put them in the chat, and Daniel will be more than happy to answer them.
Perfect.
Accordingly.
Perfect. And to start out, just to kind of test that feature and everything, if there's a way that we could take a couple minutes and I can get an idea of kind of what some of your goals are, I want to make sure that this is as relevant as possible and as meaningful as possible to you. You know, why is it important to learn about VA buyers? If you could put that in the chat, and I can make sure I can see it. I think you must have a Q&A if there, and I can kind of talk through how we're going to do that. If you have the box to ask questions, you can put questions in that, and at the breaks, in the section breaks, I can stop and answer some of those questions. And I'm going to try, we only have an hour, so I'm going to try to get through the information relatively quickly, because some of it's going to be elementary for a lot of you guys. And then I'll leave time for questions at the end too. So Shirley, I only see, I'm not getting any chats coming through.
Okay, I do see a Q&A. Someone is in the Q&A.
Yeah, I did see that. Oh, it says chat is disabled. Is there a way to enable chat at all? Do you know?
It should be enabled. Okay, let me go. I don't know if I can go back in and do it now, but I will try. Otherwise, we'll just have them put it in the Q&A, since that seems to be working. How about that?
Okay, that sounds good. Yeah, if you guys just want to put it in the Q&A, I suppose you can put in the Q&A, and I'll just try to roll with it. And Shirley, if you end up able to enable chat, that makes it super helpful, because then I can kind of stay on track with that. Let's see. So Laura says that she lives in an area where there are a lot of VA homeowners, need to know how to work with them on an offer. That's perfect. Thank you for that. Okay. All right, so I can kind of just get started. And I know, Shirley, yeah, if you have something that you want to stop me on, I want to try to make it as interactive as possible. So I'll probably stop at the gaps, but you can always put into chat or whatever mechanism you have. I don't know, there's only 8 or 9 of you guys. So if you wanted to raise your hand and ask an actual question, I'm not sure if that's disabled also, but we'll do our best to kind of work through everything. Laura Benefits, thank you. And then, okay. I'm just clearing these out, and we'll get rolling. And if you have questions or you have comments or anything, just throw them in whatever you can for now, and we'll work through it. So real quick, I wanted to go through the San Diego military landscape. San Diego, to your point, Laura, has a lot of military around. There's 7 major military bases, 3 major branches of service. Army's around, but it's mainly Navy, Marine Corps, and Coast Guard. Navy has Point Loma. It has 32nd Street. It has Coronado. Marine Corps, obviously by us up here in the north, has Pendleton. We've got MCRD San Diego, where all the recruits come, or not all of them, but half the recruits come. And then we've got Marine Corps Air Station Miramar. And then Coast Guard has a pretty, not a big footprint, but down by the bay. You know, they've got their Coast Guard base. So there's actually 110,000 active duty military members last time I checked. And when you factor in family members, that's 230,000 people around. That's 7.6% of San Diego's population. So it's a pretty significant population in San Diego. And there are a bunch of opportunities. To Laura's point, military families are always on the move and they always need resources. So imagine coming to a city where you don't have really any resources. And for you as an agent or me as a lender, most orders are only around 3 years. So it creates opportunities to help when buying, to help when selling, and even in property management, if that's an element to your business that you do. Military families also depend on each other for advice and referrals. They're very tight-knit families or tight-knit communities. So if you show a level of expertise in VA, it creates an opportunity for referrals to other military families. Not necessarily now, but potentially in the future, if there's economic downturns, active military income is not heavily affected. So when unemployment becomes problematic overall, military buyers still have strong and really, from our standpoint, easy to document income. And they receive tax-free income. So tax-free housing stipends. So BAH is a term that you'll hear. It's called Basic Allowance for Housing. It's a tax-free income that they get that can be used to purchase tax-advantage assets like homes. So you can use a tax-free income to purchase a tax-advantage asset, which is phenomenal benefit for military buyers. So I do courses for consumers too all the time. I do the military. I do courses on the military bases and that kind of thing. And so one of the slides that I'll always bring up is the cost of not buying. So there's a definite cost and hey, Shirley, can you guys still hear me okay? Something's weird on this side. Can somebody
I can hear you.
put in? Okay, got it. Okay, cool. Yeah. All right. Got it. Oh, there you go. All right. Sorry about that. So this is a slide from my my VA homebuyer seminar. It basically takes the rank of the service member. It takes how much they receive in tax-free income for basic allowance for housing. And then if you project that out annually, and then you project it out for a 3-year term, which is usually like a really good, a typical deployment schedule or a typical time at a specific base, it's $100,000 to $135,000 in that range. Is about to go up of cash that just goes out the door. So when you can kind of show people the opportunity cost as well as advise them well on the risks too, because there is risk to home buying. Obviously, as you guys know, you can kind of point people in the right direction. So one more thing, San Diego veteran landscape, 250,000 veterans live in San Diego. So again, there's a massive opportunity to be able to help people in this community, in the veteran community. 40% of veterans in San Diego live in North County. It's the third largest county in the United States behind Maricopa and Los Angeles. And it's the largest county in the United States for what would be considered post 9/11 veterans like myself, like veterans of Iraq, Afghanistan, that era. And 15,000 veterans out of those bases separate each year, and about 7,500 stay or try to stay. And a lot of them have higher levels of education through GI Bill, through tuition assistance and that kind of thing. And you'd be surprised too. I mean, a lot of these companies, they become federal employees and tech reps. They go to work for Northrop Grumman, or they go to work for Cubic, or they work for companies that are really sought after companies. So there are definite opportunities in the veteran space as well. So hopefully that gives you a good idea of kind of what the landscape is real quick. And here's another slide from the, obviously from the veteran side, if they are going to stay, this is if you guys are familiar with Keeping Current Matters, the Federal Reserve hasn't updated this in a while, but the difference in net worth between a homeowner and a renter is massive. So if you can educate people on how to become homeowners, especially in the veteran community, if they plan on staying, there's a massive benefit to them, and there's a benefit to you as a business owner serving that community, because again, if you're working for referrals, it's very, very easy to get referrals when you build trust in that community. So real quick, from a just from an agenda standpoint, the first thing I want to do is just lay a groundwork. It's going to be really basic, just a home loans 101. It's really, really quick. I do this with with consumers too, just to kind of like, if you don't understand loans generally, it's going to be hard to understand the VA home loan. So once you understand the loans generally, then you can understand the benefit of the VA home loan. And then I think what's most useful and what's super helpful is I'll give you a sample scenario, like as if we got a pre-approval for a sergeant in the Marine Corps, I have a sample scenario, and I'll show you kind of how we look at that and the incomes and things that work and don't work. And then also how to solve problems. If your client doesn't qualify for enough to buy what they want to buy, what are the adjustments we can make? If a client is getting out of the military and knows what they want to buy, but they don't know how much they have to make, I'll show you how that works. And then VA loan frequently asked questions and miscellaneous stuff is just kind of cleanup. So I'm going to clean up with like some of the appraisal questions and some of those things that that come up constantly, especially on the real estate side. And so I just want to make sure to dispel some of those myths and stuff. So hopefully that's good. All right. So my background, real quick, I was in the Marine Corps from 99 out of high school. So high school to the Marine Corps. I spent 5 years in the Marine Corps. I was in the aviation side. I worked on F-18s. I was stationed here at Miramar, and then Iraq and Afghanistan kind of happened. And then all that stuff, I mean, it kind of like went out the window, but yeah. And a lot of us in the Marine Corps weren't dreaming about going out and working for federal government or anything like that. It was like, we were reading Rich Dad, Poor Dad and wanting to start a business. And so I kind of randomly fell into the home loan side in 2004 when I got out. I didn't know what I want to do. I just knew I didn't want to get a job, like a traditional job. I was done getting yelled at, I guess. Even though the Marine Corps was great, but I started out in the lending side, and then really quickly found that I wanted to really focus on the VA side, just because there was so much benefit to it, and it made such a positive impact in kind of my transition. So now with the Lehman Group, we hire, train, my assistants are military spouses. There's a thing called, and I don't know if any of you are interested or if any of your companies are interested, but you should definitely know about what's called the DoD, the Skill Bridge program. That I have a couple of guys going through the Skill Bridge program now, where they're the last 6 months of their duties of their enlistment in the Marine Corps or in the Navy or whatever, their duty station becomes my office, and they can do internships and learn the business and learn how to get into real estate or learn how to get into the lending side. And they still get their salary and so it makes it a really good on-ramp for anybody that wants to develop some kind of a veteran hiring program. It's a great program. So keep that in mind, and I can answer any questions you have about that, because it's a really, I wish I would have had it when I was in. And then I wrote a book called the VA Home Loan Field Manual. It's a really simple, almost drills down on what we're talking about today. And then at the end of the workshop, I'll give you the link so you can just download the PDF version if you want it, and the slides to this. So I can get you the slides for this and that. So I'll get you that at the end of this. And I have the physical books too. And so I don't really sell them even. I just put them there at the bases, and they're in some offices and stuff like that. So if you want actual physical books, they're just education. They're built like a field manual. Like we have field manuals for cleaning rifles and field manuals for land navigation and all that stuff. And so I made a VA Home Loan Field Manual. And then there's also a course called the VA Home Loan Field Academy where clients can go and kind of just go through this course. But got a question real quick. Let me grab that. Keep losing connection. Yeah. So yeah, I think Shirley is recording, so she'll be able to send that out. Okay. And then the other thing is just, the thing I like doing most is this. So I really appreciate the association letting me come on and do this. I just do education for consumers and on base, off base. And so any opportunities that I have to talk about this with anybody, it's really helpful. So I really appreciate it. All right, real quick, Home Loans 101. In order to understand VA, you kind of have to have a baseline understanding of just how home loans work. And this is, for some of you, it's going to be really elementary, but it's also going to go really quick. So first things first, with any client you ever have, the only thing we as a lender are going to look at initially are credit, income, and assets. It all falls into those three things. Obviously, later on, we're going to have property, right? We're going to have to vet the property, but credit, income, and assets are the key three major characteristics, which lead to two major lending concepts, which are debt to income ratio and loan to value ratio. And again, don't even worry about VA in this. Don't even worry about how VA fits into this. I'm just defining terms and kind of explaining the concepts, just so we have a real solid foundation. So most of you guys understand credit. Again, these slides, a lot of them are carried over from our consumer centric. So a lot of people don't understand some of this, but most of you guys understand credit. The one thing I would say is that when we pull credit, a lot of times people think their credit dropped because they pull it on Credit Karma or they get a free credit report. Just know that there are different algorithms. So a lot of times the credit score didn't drop. It's just that we're pulling from a different algorithm. And a lot of times those credit companies like Credit Karma are using a different algorithm, and it's almost intended to show their credit higher so that they borrow more from their vendors, right? So the two things that we'll be looking at on the loan side are FICO score and monthly debt. Again, this is super, super elementary for you guys. We're looking at the credit score, and then we're looking at the monthly debt. The monthly debt is only minimum monthly debt. We're not looking at at how much they pay or what the balances are. We're looking at monthly debt. Income is the most important thing that your clients are going to have to contend with in terms of how much they qualify for related to debt to income ratio. So we need a history. We need it to be stable. We need to document it. There's stable income, which is like in the military side, you got base pay, BAH, BAS, retirement pay, salary income, or salary income on the veteran side, full-time hourly income, service-connected disability. These are all things that don't change. So from an income standpoint, when the income goes up, like if someone was to have a $100,000 salary and they got a raise to 120, we don't have to average that raise. It's a raise, it's fixed. On the other hand, variable income like part-time, business, overtime, rental income, and bonuses, generally we need a history, not necessarily because we don't believe that it's going to be there. It's because we need to quantify it. It's hard to quantify something that's not set in stone or fixed. So that is income that can be used also, but it's just something that takes a little bit more of a calculation to figure out. So income that can't be used, cash under the table, rents from the same unit that you occupy, although that may be changing. Business, overtime, bonus, variable income. If we don't have a history, if you just started a business, it's very tough to do. There are asterisks to all of this stuff. There's all sorts of different off the wall programs that you can kind of pull from, but this is just a generally speaking. There's a question all the time on the military side. When we get out of the military, we have a GI Bill and we get now a housing allowance from the GI Bill, but there's no continuance to that. So you can, when I talk to clients, I tell them you can factor that income in when you make your decisions related to what you feel like you can afford on a monthly basis from a personal finance standpoint, but the lender's not going to let you use that income to qualify for the loan. And then the one thing that I want you guys to be really, really careful of is military income if you have less than 1 year left until they get out. So when we check and we pull the, if you have somebody getting out in 6 months, getting out of the military, and they're trying to use military income, if they submit the loan like that, they're not going to let them use that income if they don't have a year left on that EAS until that end of active duty service, EAS. So there's a workaround to that in the sense that, and I always tell clients, like, look, if you write us a letter saying you intend to reenlist and your command says you're eligible to reenlist, we can use the income. Then once you buy the house, when that time comes, I mean, if you decide not to reenlist because you changed your mind, I mean, that's none of my business, you know? So that's kind of like what we always tell people. But we're not telling them to do that. We're just saying hypothetical. I mean, that's in essence how that works. So I hope that makes sense. Assets, I don't really have to go into. It's your down payment and closing costs, that kind of thing. We get them from, bank statements, that kind of thing. All right. And then real quick, you guys probably understand this, but just understanding the basics, debt to income is a relationship between gross monthly income before taxes come out, and monthly obligations. So in essence, your prospective house payment, I think you guys can see my mouse, your prospective house payment plus monthly debt, car payments, credit cards, all that stuff has to be under a certain percentage of gross income. Generally, conventional, that's around 45 to 50. Generally, FHA, that's around 55. And generally around with VA, that's, closer to 60%, but that's debt to income ratio. Real quick for you guys, what's important about debt to income ratio also is whether you have a really low debt to income ratio and you qualify with flying colors, or you barely qualify, it doesn't change rate. Credit can change rate sometimes, whether you're buying, not in VA, but investment properties, condos, that can change your rate and adjust your rate. Those are rate adjusters. But how much you qualify by debt to income wise doesn't really change your rate. It's kind of pass fail. So a lot of times our job as lenders is really to figure out what they want to buy. We'll qualify them for a max, and then we'll figure out how much they want to buy. And then we'll trim it down. Like if they have really funky income and a salary and they qualify on the salary, take all that funky income out of there, simplify your file, make your life easy, and open up the ability to write shorter timeline offers so that you guys can be more competitive. And the client doesn't go nuts tracking down a document from an employer. It's crazy. So it's pass fail. So that's an important point there. And then loan to value, this relates to VA and how VA works. You guys understand this. How much do you owe versus what's the value of the property? If you buy a house for $1 million, you put 20% down, that's an 80% loan to value. I think if you guys have questions about that, let me know. So I'm going to stop and answer some questions real quick. And if you have questions about that section, let me know. So, all right. Laura says, in order to help VA buyers, do you need a special accreditation, or can any realtor help VA? Any realtor can help VA. A lot of times those accreditations are the same thing as like, I don't know. So, people come up with these accreditations. And so I don't want to knock any specific accreditation, but there's no accreditation specifically that's needed as a realtor to help a buyer. It's more of something to put by your name if you wanted to show that you work with military buyers, like a military buyer specialist or something. Again, I don't know much about the entities that do that. So I don't want to say either way, but the easy answer is no, you don't need some kind of a special accreditation. You can work with them. Barbara, thanks for the question. Can we use SSA income? Absolutely. Yeah, you can use SSA income. That we have a veteran right now using SSA. And can you go through the COE process? Is that certificate of eligibility process? Yeah. So Edward, if that's certificate of eligibility, I'm getting there, and on the VA loan side. So absolutely. All right. Any other questions, pop those in, and I'm going to keep cruising. I've got 10:24. So I'm going to keep going and make sure I got a lot of time for you guys at the end. All right. So the VA loan. So first of all, the VA loan is not provided by the VA. Banks and lenders supply the loans, and VA does a guarantee on behalf of eligible veterans. And that's where I'm going to get to that question of eligibility. Prior to 2020, they were capped at the county loan limit. You could go above the county loan limit with a down payment, but prior to 2020, it was capped at the county loan limit. So let's talk about eligibility. To be eligible, eligibility is different than qualification. This is eligibility, 90 days active duty during wartime. And wartime doesn't mean a combat zone. That just means during a time where it's deemed that we're at war, which is any time since September 11th, I think. 181 days active duty during peacetime, 6 years reserve service. Or to answer your question, if you were a reservist for only 3 years, but let's say you got activated and went to Kuwait or something like that, and you had 90 days active service during the Iraq conflict, but you were a reservist, you don't need that 6 years if you're activated. And then there is a circumstance where the service member's spouse receives or it can be passed on, but it's not super typical, thankfully, because it's only in the case of a service-connected disability, a death as a result of a service-connected disability, or if or dies in service or is missing in action. And those circumstances are again, very atypical. And there are some other caveats related to not remarrying and that kind of thing. So those can be a little bit more complicated, but luckily we don't run into that too much. So when you have the veteran go directly to the VA to get their certificate of eligibility, it can take a lot of time. They send their stuff in, not a lot of time, but it takes a while. We have most lenders have a portal. It's called a VA portal. And you could just put in the social security number, put in the last name or whatnot, put in the year of birth or the date of birth, and it'll pull up an automated certificate of eligibility really quick. And I've kind of highlighted a certificate of eligibility here. Shows the name of the veteran, identifies them, shows the entitlement code, which is kind of like, when did they serve? What era did they serve? Back to your question about kind of, when they served long ago. It shows any entitlement charge. So here you can see that this person has a loan already and what their entitlement is charged, what the loan amount was in the entitlement. That goes to if you want to use it over and over. It talks about whether it was first time use or subsequent use. And then it also talks about the VA funding fee and whether or not they're exempt from the funding fee. And this is where we would document income, because it would say veteran is exempt from funding fee due to receipt of service-connected disability in the amount of $1,000 a month. And we can use that income to qualify. And I'll get into the funding fee in a little bit, but if you have service-connected disability, it waives the funding fee. So hopefully that makes sense. So who can use the VA loan? The veteran or the military member, the veteran and the spouse, a veteran and another eligible veteran, like two veterans get together and buy a house together. The only circumstance where a veteran and a non-veteran can buy is it has to be a very, very, very close relationship. Like, let's say people aren't married, but it's like a community partnership, or what's it called? It's just either a fiance or something very, very close that's documentable. And the problem with that is you have to go to VA for approval and try writing an offer and getting it accepted when you need an extra, however many days VA is going to take to approve that. And it needs a down payment. So those are very, very few and far between and tough. And then we talked about the widowed spouse. Notice what's not on here. Can I buy it with my brother? Well, if your brother is a veteran, yes. If your brother is not a veteran, no. Can I buy it with my parents? Well, are your parents veterans or are they not? The spouse is the only non-veteran that simply goes on the loan. And in community property states like California, the spouse's debt, regardless of whether they go on the loan, if they're married, the debt has to go on. So that has to be addressed. And then this is a big misconception even now, prior to 2020, VA limited no down payment financing, 100% financing to loan limits, to the loan limits. They mirrored conforming loan limits, but you couldn't go above that without a down payment. In 2020, there was HR 299. Now you have no VA loan limit. You could buy up to whatever you want. We had a client in LA buy a $2.5 million property. He's a brain surgeon now. He was a Navy medic. Now he's a brain surgeon and he qualifies for it, obviously, for the payment and stuff. But he bought a $2.5 million property with zero down last year when rates were in the twos still, so it ends up being a really amazing program. And for a lot of you guys, for a long time, it was like, well, my market is more Carlsbad or my market is more Encinitas. It's not so much Oceanside or Temecula or Vista, and now it's like, I think there's a real spot for opportunity with the veteran community. I'm a veteran. I live here in Carlsbad and Seabright, and so we would use VA 100% of the time. And I think there's some opportunity there for people that kind of understand this change and the benefit. It doesn't mean you can't put a down payment, obviously. It just means you have some flexibility. All right. So the question we get from clients all the time is, hey, even if I'm eligible for VA, is that the best option? So I'm going to use this as an opportunity to kind of walk you through the benefits of VA versus other options. So I know I'll get people that argue with me on this. And I know that from an offer standpoint and logistics, this is not always true. From my standpoint, from a loan standpoint, generally speaking, I'll tell clients, if you can go VA, VA is better than conventional. If you can go conventional, that's better than FHA. If you can go FHA, that's better than renting. Again, kill me for that statement later, but I know there's caveats, but this is just very, very generally speaking. And here's kind of what we'll do is I'm going to take out FHA and renting and just look at VA versus conventional. Generally speaking, the VA loan runs to 1/4 to 0.5% cheaper in rate than conventional loans at similar terms, generally speaking. From a credit standpoint, conventional, if you've got a 740 plus FICO, Fannie Mae's LLPAs, their price adjustments don't go higher than 740. If you got 740, you're good. But if you got 720, you get hit. 700, you get hit. At 20 point increments, you start getting hit. VA really doesn't have those issues for credit hits. So VA is much more less credit sensitive than conventional. The VA loan allows for up to 60% DTI. VA is not really a DTI loan, but conventional, you'll generally get a 45 to 50% DU approval on conventional loans, like a Fannie Mae approval at conventional. VA allows you to go up to 60 because it's more focused on residual income. So again, that just allows for more flexibility. That doesn't mean that you have to max out their purchase price to 60. That's just where we find we get real easy automated approvals with VA. And then this is the gist. This is loan to value. So if you've got a $500,000 property, 20% down is $400,000. That's an 80% loan to value. Hopefully that makes sense. This is how VA works. This is in a nutshell, the biggest benefit of VA and how it works. Most people have a lot of people have the misconception that a lot of your clients have a misconception that the bank requires 20% down. Maybe not so much anymore. That was a long time misconception. Obviously, you guys know that they don't need 20% down. This is on a conventional circumstance. But if they put less than 20% down, you have mortgage insurance to make up that difference because the bank requires 20% safety. They don't require 20% down, right? But if you put 20% down, that satisfies their safety requirement, their gap, the amount of equity they need to feel safe. And you don't need mortgage insurance. If you put less than 20%, you need mortgage insurance because that is an insurance policy that covers them to that 20% down and beyond. What VA does is based on eligibility, they just do a guarantee. So the VA guarantees 25% of the loan. And because they guarantee it, that exceeds the 20% that the bank needs. So you don't need a down payment or mortgage insurance because if they don't pay, based on their service, the VA will come in and provide the bank a guarantee so that they know that the bank doesn't lose money. And that, in a nutshell, is how the VA loan works and what the biggest benefit of VA is. So in summary, less restrictive credit, lower interest rates generally, no down payment if you got full eligibility, no monthly mortgage insurance expense, and more flexible debt to income. So in most cases, if an individual qualifies for VA, that's the best way to go. Questions about any of that stuff? Everybody good? Okay, if you have questions, pop them in there and I will, can somebody send me like a yes, I can hear you just to make sure? It's kind of weird without the chat. I just want to make sure that in Q&A, if you could just say, I can hear you. And okay. All right, sweet. Thanks. Thank you, Laura. Okay, so I'm going to run through a sample pre-approval of a military buyer just to kind of give you an idea of how this works. In essence, I'm using a Marine Corps sergeant. He's active duty with dependents, 6 years time in service. That means like 6 years that they've been in the military. Sergeant E5, and then I'm going to say he's got $350 a month in a car payment, $100 a month in minimum credit card payments. This example is kind of funny because I put this in like at the beginning of the year. So a lot of you guys will probably scoff at this too, because obviously rates at the beginning of the year and rates now have changed dramatically. Crazy. But anyway, so 6 years time in service. So here is the profile of this hypothetical person's income. $32.73 a month in base pay, $28.98 in BAH, basic allowance for housing, $407 a month in basic allowance for sustenance. That's for food. You don't have to keep their payment under their BAH, but know that in a military member's mindset, sometimes they connect those two. So they're like, oh, I have basic allowance for housing, I should keep my housing under that. So that's not necessarily an issue. It's something just to address. They can use whatever, and the income just goes into a pot. So $65.78 per month. So with debt to income ratio on VA, again, generally we're working on 6%. So all I have to do in any situation where we do a pre-approval is I take the income here, 60%, and the house payment plus the debt has to be under 60% of the gross income. And so solving for X is how we find the max payment that they would qualify for, or not qualify for. Apparently, this is what they would qualify for. So I got to fix that typo. All right, so let's go through it. 6578 in total income. If I just take 60% of that, that means I have bandwidth of 3947 for house plus debt. I know that I've got a car payment and credit card payments, minimum payments of 450 a month. So if I subtract that 450, I come up with 3497 for the house payment. And that's what we kind of work off of to determine what the max is. And that's why when agents let me know, it's like, I have to figure out, okay, is there an HOA? Is there not an HOA? Because it's not super simple. It depends on HOA and all that other stuff. So that's why it makes sense to kind of work really carefully when you're making offers to make sure that it's that if an HOA does come up, that it doesn't cause them to exceed this figure. So that in this case, it's 3497 is the amount on paper that they would qualify initially. When I say depending on interest rates, that's probably down from when I made this slide, but let's just go with it. So 575. So principal and interest, that was probably in the 3.5 range. So this has to change, but you get the idea at least. So for PITI, including HOA, that's that 3497. When I calculated this, it was 575 when I did these slides. Principal and interest, taxes and insurance, HOA is 3497. Therefore, that's 575. So what if your client goes out, we pre-approve them for 575 and they find their dream home, but it's listed at 600 grand. What options do we have? So usually I would ask you this, but the chat's kind of not working, but here's what options you have on any equation. And this will work for you, whether it's VA, conventional, FHA, no matter what you're doing. There's only two things you can do in this scenario. You can increase income, right? So if I add a borrower, remember I told you tax-free income is BAH, so I can gross up that income. You can show additional income. So any additional income will increase that amount. Or what you can do is decrease debt. So what if we paid off some credit cards? The other thing that I'll say about paying, so that obviously you can see how that would improve their ability to qualify, and that would increase their ability to qualify if we increased income or decreased debt. The unique thing about VA as it relates to decreasing debt is that the seller credit can pay off consumer debt. So we had a situation where there was a property in Murrieta and it was priced really well, and the guy wasn't qualifying. He qualified. He tried to get pre-approved with two different people. They just kept getting rejected. We increased the sales price an extra $7,000 and got an extra $7,000 in seller credit, paid off their car with that seller credit, and that brought their DTI down because the $7,000 it increased maybe cost us $50 a month or less. And the payment, the car payment, they only owed $7 grand, but their payment was $400 a month. So that imbalance allowed us to so when you understand DTI, you can solve for a lot of problems. Hopefully that makes sense. And we run into this a lot too. What if you know how much home you want to buy, but you're trying to figure out how much income you need? Again, it's just an exercise in math, right? So let's say you've found them a property and the payment's going to be $3,000, and we know that their car payments, credit cards, and all that stuff is $850. That's $3,850. If I divide that by 60%, that tells me how much income they have to make to qualify. So if you understand this debt to income concept, you can understand exactly what you need to do, not just for what someone qualifies for, but how to solve those problems. All right. Any questions at all? We're kind of rounding the turn, and time-wise, I've got 20 minutes left. So any questions at all? Okay. Use the Q&A if you can. VA loans are for first-time buyers only. True or false? Anybody? False? False? Frank, false. Good job. All right, cool. All right. That is false. The only restriction is that the VA loan must be used to purchase a primary residence. at the time of purchase. It has to be a primary residence. You can't purchase using a VA loan, an investment property, or a second home. It has to be a primary residence. All right. My client can have 2 VA loans at once. Who's brave? Barbara, yes. Laura, no. Ooh, we got the first split. All right. Survey says true. If entitlement remains, you can use it if the new property is a primary residence. So let's say I bought a property in Virginia. I'll say it like this. The VA loan's kind of like a rechargeable battery. You have a certain amount of charge. You have a certain amount of eligibility. If you use it all and then you sell that property, it reinstates it. So you can use it twice in that sense, but 2 loans at once also. Let's say I'm in Virginia and I bought a house for $200,000. That only takes a portion of my Service Connect of my eligibility. If I then move to San Diego, I have remaining eligibility, and that's where the county loan limits come in, and I can calculate for you how much remaining eligibility they have to do 0 down. And even if that doesn't cover the purchase price, they can still go above and beyond that with down payment. So that is absolutely true, and it just depends on it. Everything is structure, everything is planning. So, and I would say you guys should definitely, especially in this market, start thinking about shifting to how are you filling your pipeline for 2023 and getting people off of the buy now when it's so, if they want to buy now, fine. And I don't think that's a bad idea. I just think that you could capture a lot of people if you shifted the focus to putting a plan together so that they could buy in the future whenever they're ready. It's just a much bigger addressable market. Okay. My client can buy a $1.5 million property in San Diego with 0 down using the VA home loan. Yes. And we kind of covered this. So Barbara, you are, Frank, you're good. You guys are all absolutely correct. As of that 2020 change, full eligibility, it's just not capped. You still have to qualify, income, debt to income still has to work. And so again, some of your clients on the VA side will say, well, I'm eligible. Well, eligibility from service is different than qualification. My client can buy a 4-plex using the VA loan. How about that one? And when I say 4-plex, sometimes people don't want to know what I mean. It's like a 4-unit. All right, we got a split. Frank says yes. Laura says no. Barbara says no. The answer is absolutely yes. So 1 to 4 units is considered residential, just like anything else. You can live in one of the units and rent the other ones. I did a video on what's called the VA house hacking. And it's almost like a lot of times with military, you get military spouses who are really interested in schools and single families and all that stuff. And then you get active military, the actual military veterans themselves, or the military guys themselves, and they're interested in investing. They want to be investors. They're reading Rich Dad, Poor Dad. They're watching like Grant Cardone stuff in the desert. And so you get this thing called a VA house hack where they want to buy a 4-unit. They want to live in yet one, rent out the other ones. And from a debt to income standpoint, you can use that income to qualify. And a lot of times the biggest problem is availability of inventory. But if you can find someone who's looking for a condo and then you find them a 4-unit, same living situation, but like, there are some benefits of buying a 4-plex and doing house hacking as opposed to a condo, which would have an HOA and all sorts of other stuff. So that is I don't know if you'd be able to find it, but there's VA house hacking, and there's a video on YouTube that we did that showed a condo in Oceanside versus a 4-unit in Oceanside and how the math worked out. And maybe you can message Shirley or something like that, or I can send you that link or something, because it's really, really interesting. All right. Even though my client's spouse is not a veteran, they can still go on the VA loan. We kind of covered that. So that's true. Obviously, a spouse's income can be used. There are circumstances where the VA may not be the best loan option. That's obviously true. When planning any job, you want to figure out the goal and then apply the right tools. I always tell clients, like, you don't want to pull out your hacksaw and then find out the job is changing a doorknob, so let's figure out what the goal is first and then apply the tools to that, as opposed to just running off and saying, hey, this is the right thing. That's the right thing. So for example of, when the VA would not be good, let's say they want to buy a big old awesome house somewhere else, but they don't want to waste their BAH now. They may elect to use conventional to refrain from using their VA. They may buy a small condo here using conventional and keep their VA for later. Or let's say your client's planning on putting 20% down anyway, so they're not going to have mortgage insurance and they're required to pay a funding fee, which the conventional loan doesn't have. That may be an opportunity for us to look at conventional as opposed to VA. In any case, again, getting an education and putting a plan together are the biggest things you can do. And there's really no limit to the earliness of what people should, if people put that plan together early, they'll put themselves in a really good spot. So because I mentioned the funding fee, this is the chart of the VA funding fee. VA charges a funding fee. It's rolled into the loan. So if you do a $100,000 loan, I know that's unreasonable, but just to make the math simple for me, if you're first time use, like you've never used the VA loan before with no down payment, it's a 2.3% funding fee. So what you'll see is $100,000 is your purchase price, $2,300 is your funding fee, and it's rolled into the loan usually. So the loan amount is $102,300. You can see here, if it's subsequent use, like they're using it for the second or third or any further time, that jumps to 3.6. So imagine buying $1 million property with $36,000 in fee. That's where we end up looking from a planning standpoint of maybe putting 5% down, which cuts that down a lot, or 10% down, which isn't as big of a drop. So this is kind of a sweet spot. But service-connected disability rating waives that fee forever. So if they have 10% or more service-connected disability, that fee is zero. So another really, really important thing to kind of take note of, and another secret kind of like loophole is, let's say somebody's out and they don't have service-connected disability, but they think they probably could get it because they just never went to the VA for it and it wasn't a priority. They want to buy a house. It's going to take the VA forever to process that claim. It could take a year. But if you have them put the claim on file, it'll get timestamped at the VA that the claim was on file. Then they buy a house, they pay the funding fee. Later on, after they close, they get their disability approved. It's backdated. So what'll happen is you can go to their servicer, you can go back to the lender, you can go back to the VA and say, hey, here's where I applied for it. It was backdated, and they'll give them that funding fee back. So that's a huge benefit if you kind of know how to advise clients. And people have lost tons of money in funding fee just because they didn't know that, because they went to the wrong person. They weren't able to advise them of that. I mean, imagine, getting $36,000 back because you just knew to apply first. We just had a circumstance like that. He was buying in North Park and he just hadn't done a service-connected disability yet. He did it. He probably made over $36,000 just because he knew to apply first. All right. Time-wise, 10:48, still looking good. So I'm going to just go over some real quick miscellaneous VA stuff that I get questions about, and then we're good on the Q&A stuff. And I'm going to hold off on this question real quick, and we'll just run through some real basic stuff that I get questions on from agents all the time. Non-allowables. So there are VA non-allowables, but they're a misconception. Most agents think that sellers have to pay a VA buyer's fees. They do not. Non-allowable fees, there is a list of what are called non-allowables. This is probably the most confusing concept, and I can answer any question or talk about it with anybody that has questions about it. But non-allowables are the VA do not allow the buyer to pay for these fees. However, if they don't exceed 1% of the purchase price, then the buyer can pay them. So as long as your lender is not charging a 1% origination fee and using that 1% up front, which some banks do, like Navy Fed and some of these places charge an origination fee of 1%. When they charge that fee, it eats up all the bandwidth and the seller does start having to pay for stuff. But if the lender doesn't charge a 1% origination fee, we don't charge that fee, because that's a big problem if our clients have to get the seller to pay their fees. Obviously the market now is different than the market 6 months ago, but as long as those fees don't exceed that, you're good to go. So I don't want to dwell on that too much, but and I know it's confusing. There's a list of things that generally add up to maybe $1,500, a couple grand. Because of our purchase prices and our loan amounts here, we never run into that issue if we don't charge a 1% fee. One thing you will run into, and one thing I want to address, is termite. Termite, the buyer cannot pay for the report, but the report's like 50 or $100. And usually that report fee is waived if there's work to be done, and the buyer can pay for the work. The seller doesn't have to pay for the work. You can negotiate that the buyer can pay for the termite repairs, no problem. Do I have a termite thing in here? I probably do. If I don't, I'll hit on that real quick. VA is a residual income loan more than a DTI loan. So VA just wants to make sure that after all the payments are made, they still have money left over. So that's not really super important to you guys. It's just if you hear residual income, that's what that means. That's something that we check. Condominium projects, including detached condos, have to be VA approved. In most cases, VA condo approvals do not expire. So here's definitely pay attention to this. FHA condo approvals expire after a certain period of time. You have to get them re-upped. It's a huge pain. VA condos don't expire. When you search for a condo, I put the link below on the condo thing, but you can just Google VA condo lookup and you'll come up to this vba.va.gov thing. VA is horrible. Not generally speaking, VA is horrible at this. What happens is if you go into that condo search, and let's say you're searching for a condo complex called Seabright, right? For example, right? If you typed in Seabright and you typed the city and you typed the county and you typed all that stuff, you would most likely, you're creating more opportunities for it not to show up, even though it might exist. Because what if VA spelled Seabright wrong? What if it was 2 words instead of 1? Their algorithm does not look for close stuff. So what you want to do is when you go on that list, just put the state and county, or just put the city and drill it down to a list, and then go try to find it alphabetically then. The other thing is that you got to be really careful of is sometimes they don't, like, let's say Seabright was built, and when the time the VA condo approval was done, it wasn't called Seabright. It was called parcel number 12345. Then you're not going to find it either. And that's a big problem too. So make sure when you find something and you're verifying all this stuff, that you're working with your lender to like actually look at the parcel numbers, working with your title to figure all that stuff out. Generally, agents are pretty good on the listing side when they're listing what financing is available, and you can ask them. But here's another trick. If you have in the MLS, because condo approvals generally don't expire, the VA ones, if you look into that project, like let's say that you're looking at a certain complex, if you're looking into that project, and if you look at all the historical sales in that project and you look up and see what kind of financing was used to close, if there's any VA in that, because condo doesn't expire, it's probably there. So if you can't find it on the condo list on VA, but you can find it in the MLS and there's closings, it may be a PUD, it may not be a condo, and you may not need it, or you may just not be finding it and just going to take a little bit more digging in the site. And then also you can reach back out to that agent and say, hey, who did this loan? Let me reach out to them and find what they used. So condo is a big deal. And if you have questions about that, let me know. Appraisals and what are called Tidewater. It's slightly different from conventional or FHA. Appraisals ordered directly through the VA portal. And then the way it works with conventional and FHA is you order the appraisal, appraiser goes out, they bring the report back. And if it's going to come in short, it just comes back short. You say, oh, this appraisal came in 10,000 less than purchase price. Okay, let's go back and do a rebuttal, or let's negotiate, or whatever the situation is. The VA, because they like to be special, does what's called Tidewater Initiative. Why it's called Tidewater Initiative? Because the VA likes to be special, apparently. I don't know what that means. But Tidewater basically means we order the appraisal through the VA portal. They go out, do the inspection. They look at the comps. They come back. And if you get a Tidewater, what that means is, hey, if you don't send me additional comps or send me your estimation of value and how you came to this in the next 48 hours, the report, I'm just giving you a heads up, the report's going to come in short. So it gives you an opportunity to send what you got, but it's kind of blindly, which is tough. You know what I mean? And then the appraisal comes in, and if it comes in short, then you could go back and renegotiate, do all that stuff, but it gives you an initial kind of deal. I think that's my, yeah, before I go to the to recap, this is just a recap, so this is less important. Back to termite real quick, because I should probably add a slide for termite. Conventional and FHA, you don't need termite clearance. A lot of times people think they do because they put it in the contract. So if it's in the contract, the underwriter is going to request it. If it's conventional and FHA and an issue comes up and you don't want to do termite later on, but it's in the contract, you can do an addendum, remove termite, and the underwriter should remove that requirement. With VA, Section 1 is always required, always. So Section 1 clearance is always required. Section 2 is underwriter discretion. So if it looks like there's an issue that they call out in a Section 2 item, it's not automatically required, but the underwriter could potentially say, hey, look, this is going to lead to an issue in the future. I need you to fix this as well. Usually, this is how it should work. This is certainly how it works with us, is the report, the termite report is due prior to doc. So prior to final approval, we need a report. But the work, the completion should be prior to funding. And that gets you out of trouble, because if you get cleared to close and then the client is comfortable removing contingencies, then it makes sense for the listing, for the seller to incur the cost to do that repair. If the seller is paying for it, again, the buyer can pay for it as well. So here's the link, that vahomeloanacademy.com/downloads. That'll get you that just links to a blank like download page of the VA Home Loan Field Manual book. If you want to take a look at that, if you want physical copies, I'm in Carlsbad and I can get you a physical copy. That's no problem. And then also the download section has a download for the buyer's VA Home Loan or VA Home Loan 101 course, but I'm going to add these slides there too. So give me a little bit and I can put that, and then you can just go there and download it. But that being said, thank you guys very much for letting me do the presentation. I have 3 minutes. That's pretty good. I've got one question in the queue. Can you get a certificate of eligibility before you identify a property? Edward, 100%, and you should. You should have the COE. You should have the income. You should have the assets. You should almost have a fully, I mean, we go a little bit further and do full underwrites on all files. So all that stuff, COE is kind of the first thing we pull, because sometimes the certificate of eligibility isn't available up front. So if it's not available automatically, we get the DD 214 or the statement of service, we send it to VA and we integrate and do all that stuff with them. So yes, you can get a certificate of eligibility right now in 2 seconds, no problem. Easy day. Any other questions? Laura, thank you so much. No problem, anytime. I'm going to just hang here, and Shirley, if I can hang and answer questions, or Shirley will come on and kick me off at some point.
No, Daniel, you're good. So you can hang as long as you want.
All right. So I'll hang, and Frank, thank you. Thank you very much. Thanks for coming on. Rachel, thank you. Barbara, thank you very much.